Today, we're demystifying how banks use your income tax details to decide if you get that loan, and it all starts with understanding what they're looking for. The first key factor banks scrutinize is your income stability. They want to see consistent earnings over several years, not just the on-off windfall. Your tax returns clearly show this trend. Regular, predictable income, as reported on your tax forms, signals to the bank that you likely have the capacity to repay a loan consistently. Next, tax compliance is paramount. Banks need to be sure you're reporting your income accurately and paying your taxes on time. Any discrepancies, missed filings, or outstanding tax debts on your returns can be red flags, raising concerns about your financial responsibility and potentially leading to rejection. Beyond just income, your tax returns provide a comprehensive picture of your overall financial health. They reveal sources of income, deductions, and can indirectly hint at your spending habits and financial discipline. Banks use this information, alongside other credit reports, to assess your debt-to-income ratio and your general ability to manage financial obligations. Essentially, your income tax returns are your financial resume for the bank. They demonstrate your earning potential, your commitment to fulfilling your fiscal duties, and offer insights into your broader financial management. By presenting clear, consistent, and compliant tax information, you significantly boost your chances of securing that loan approval.